Hello, everyone. Welcome back to the Functional Retirement Podcast, where we get technical about your wealth, philosophical about your purpose, and inspirational on your health and fitness. I'm your host, Thatcher Taylor. Today, we are going to talk about the 10 rules of investing. Now, this was all started because I bought a book off the shelf at the grocery store in the checkout line. I can't believe I did it, but I did it. So Investopedia's 10 rules of investing, and we're going to break this podcast down into two parts. Their 10 rules of investing and whether or not I agree with them or disagree with them as a financial planner that does investment management for my clients. But the second part of this is going to be the best part, because the second part is going to dive into investment management based on your retirement income distribution strategy. Because your investment strategy or investment methodology could potentially change based on whether or not you're accumulating or decumulating assets in retirement. All right, let's not delay any longer. Let's start getting into it. And investing is a very unique world. As we know now, every one of you that are listening has a different idea of what investing is. If I was to ask each and every one of you listening, what does investing mean to you? You would each give me a different answer. It could go all the way from picking individual stocks to buying bonds, to saving money in the bank, to buying up real estate, residential or commercial, buying or selling businesses, reinvesting in your business. There could be a variety of things that you view as investing. So today we're going to view investing as you make money doing something. You are generating some income, and you're utilizing that excess income to accumulate and grow over time, in which you could use the growth in those assets as income in your retirement journey, or you're trying to give some of those assets to heirs as you pass. That's essentially what's happening here. So that's where we're going to take this. If you're looking at real estate investing, or you're looking at buying and selling businesses, some of this may apply to you, but in general, we're looking at the traditional retail investor that accumulates wealth by investing in your traditional investment world. That's who we're talking about today. Really quickly, if you made it this far, I want to thank you again for watching or listening. If any of this is sparking interest and you want to ask me more customized specific questions, you can go to propathfinancial.com. Top right-hand corner, there is a box that says work with me. There's a little form that you can fill out. This will come directly to my email, and I'll reach out to you personally, and we'll schedule a time to meet to chat a little bit more. So if you do have more questions about if your investment strategy is matching up with your vision of retirement, you can reach out to me directly. Doesn't cost you a thing, only a little bit of time. But if it makes sense, we may end up working together on the long term, because I am accepting new clients. Thank you very much. Now let's keep going. Okay, Investopedia's 10 rules. Number 1 is start now. I agree with this wholeheartedly. This applies to how compound interest takes over time. If you went and Googled Warren Buffett's wealth over time, you would see that the vast majority of Warren Buffett's wealth happened later in his life. He was presumably wealthier, had assets through his 30s, 40s, and 50s. But in his 60s, his wealth started to take off because he spent the time setting the foundation. Now, we talk about accumulating wealth is in leading into retirement, and you want to have this wealth in retirement, which is correct. But retirement could be a long time. You could live 20 or 30 more years, regardless of what you think. It's called longevity, the risk of outliving your money. So compound interest even comes into play later in life. And we're going to get into this more in the second part of this in a few minutes, where we start to decide what kind of income distribution strategy you should utilize in retirement. So starting now is extremely important. Compound interest really takes off later in the investment strategy. So if you invest $5,000, $10,000, $20,000 over this first year, it's not going to make a ton of money in the next year. It's going to take time, but in the future, it all of a sudden will just take off. So I agree with this wholeheartedly. Investopedia, you nailed it. Start now. The next piece is the economy does not equal the markets. Now, I think this is more of just a guideline. Instead of this being more quantitative. This is more qualitative. And the reason is people try to utilize the economy, as a predictor of how assets are going to grow. But the US economy is a very, very complex system with a lot of different categories. There's consumer goods, there's tech, there's industrials, there's communications, there's natural gas, there's oil, there's a variety of different things that come into play as far as the sectors built into the economy. So the distribution of goods and services is the economy. That's not necessarily the market. The market is the place where those publicly traded businesses in those sectors are bought and sold at whatever price they think they are worth. That's different. The overall economy is so complex that what we try to do is we try to segment it out literally into segments that create the markets that we invest in. Again, that's tech stocks, that's large cap, that's mid cap, that's small cap, that's domestic, that's international. And then you can go into the very specific segments of the market to invest. So the economy does not equal the market. I agree with that, but that's just more of a way to approach how you start to develop your investment strategy. So number two, I agree, but I don't know if it's exactly how you want to build your investment strategy. But the different sectors, technology, communication services, industrials, energy, healthcare, financials, utilities, consumer staples, materials, all those things come into play in your investment strategy. But there are investments right now where you can literally buy every stock in all those segments and they perform really well. So that's a good place to go. On to timing. Timing is number 3. And timing is everything according to Investopedia. But also, I think timing means nothing. So we got to break timing down into a couple different things. Timing is being able to time the market. That's one way to look at timing. But then there's also how important right now is. This time is extremely important. There are two different perspectives to view time. Timing the market is, in general, a loser's game. You will miss out on the majority of your long-term growth and compounding by trying to time the market, because to time the market, you have to spend time out of the market. But also, time in the market is the most valuable thing because you don't want to miss bad days. So timing, as far as timing the market, is not everything. In fact, that should be avoided. But getting going now and staying invested is of the utmost importance. And this is assuming that you've built a good investment portfolio. So Investopedia puts this as number 3. I would put this closer to number 10, that you need to build the structure out. And then once it's built, then don't mess with it unless there are specific times where you need to mess with it, which we'll get to here in just a second. Let me take a quick right turn and we'll come right back. I'm not going to give you an advertisement, but I am going to ask you to go leave a comment or a review on this podcast. I appreciate everyone listening. All these algorithms with Spotify, Apple, YouTube, wherever you're listening or watching this podcast, they love reviews. It really helps these podcasts to reach new people and help them on their educational and retirement journey, which is what I'm trying to do. I don't have any advertisers on this podcast. So leave a review. Now let's get back to the podcast and number 4, which is aiming for balance. This is a really important piece because people become overweighted in particular holdings over time, which potentially hurts them in the long term. This is why ETFs and mutual funds have become far more popular, is because you can buy the fund or the whole pie, and the fund managers will cut the slices accordingly. And in those slices, you can potentially have the diversification you need or the balance in your portfolio that you already want. So for example, there are total market funds, ETFs and or mutual funds, that own every single solitary stock that's available in the marketplace, every one of them. And over time, this has been a phenomenal strategy. I'm not going to name any names because I don't want to make these recommendations, and I'm not recommending you do this, but you have the ability now to have balance by one simple purchase. And you can do this with domestic, you can do this with international, you can do this with stocks, you can do this with bonds. So developing that proper balance or allocation is going to be really important to building out a good portfolio. I agree with number 4, Investopedia. That's phenomenal. This is number 5, but I don't think number 5 should be 5. I think number 5 should maybe be number 1 or maybe number 2, and it's know what you own and why you own it. You should have a good understanding of what you're buying. They're putting this as number 5. I don't know if this is in any order of priority, but I would put number 5 as number 1, where you're thinking about investing and you're going to put your hard-earned dollars. You spend time slaving away, building your family and your life and going to a job, and you're generating this money and you have some left over and you're going to put it into a place to try to build wealth. I think you should know what you're buying. I think you should know why you're buying it and what it's used for. A simple example of this is you want to buy a house in 24 months. Maybe don't put that money in equities. And if you are going to put it in equities, what type of equities? But say you're investing money for retirement, which is 20 or 30 years away, and you put it in cash. Why would you put it in cash? It's 20 or 30 years away. So you need to know what you're buying or what cash or investment you're utilizing for the specific goal, what you own and why you're using it. Number 6 is tame your animal spirits. Again, this is more qualitative instead of quantitative. And I would put this more towards the front because you're setting expectations. You're starting to build out your strategy. And here's what I mean. Most people will sell or buy based off how they're feeling or their current experience. We need to avoid that at all costs because the market usually plummets when people are overconfident, and the market usually does really well when people are fearful because there are people out there that are making decisions that are actually not decisions. Their decision is to do nothing. So I guess it's technically a decision, but their decision is to do nothing. So people get too concerned about their emotions and their feelings and their guesses and their ideas about the market or the economy or their politics. Those are your animal spirits. There's your natural reaction to sell out. This has already happened to me in this business in the past couple of years where COVID happened, the market crashed, and 2022 was one of the worst years we've had in the past 50 or 60 years. A lot of my clients stayed the course and it worked out really, really well. We did not make any animal spirit type decisions where we sold out of fear, and it worked out really, really well. Number 7 is to be better safe than sorry. This says exercise caution when making big investment decisions. Do your research and consider your options carefully before making any rash decisions with your money. We've kind of talked about these already in some of these previous numbers, number 3 and number 6. But I think what they're talking about here is borrowing money to invest. Have you ever heard about that? People take HELOCs out of their homes. They take cash out and refinance, or they'll sell something to be able to go invest because they're really trying to accumulate more wealth. They're incorporating more leverage and more risk. Another thing would be to withdraw money from an IRA or a 401k. And I'm guilty of this. I'm not going to say that I'm not, but I'm younger, so withdrawing money from an IRA creates penalties and taxation. Try to avoid those situations at all costs. It's sometimes better to just leave the money invested and utilize other methods before spending the money. But in my case, it worked out. All the money was to start this business, and I wouldn't do it again because I felt like the fees and the taxes and the 10% penalty were costs of doing business to get this started, which has been a phenomenal decision. Thank you all who are listening, who are clients or potential clients. It's been a very great ride. But there are other things that come into play. Taking loans from 401ks that you don't pay back. Taking investment advice from people that do not give high quality investment advice, like using life insurance for retirement income distribution. Works in some cases, but literally for the majority of you listening, it's not going to apply at all. Utilizing the wrong type of annuities. Getting your advice and guidance from TikTok and Instagram are very difficult places because there's complex discussion that needs to be had around each specific instance. And you need to be safer than to take advice from places where you don't understand that you're going to end up being sorry later. Number 8 is manage your risk. This is more about diversification. I would put this more at the front because this is on the build out of the investment strategy. This is understanding how much in a market drop you're willing to accept. A portfolio that's all equities, you have $1 million all in equities, could very easily go down to $700,000. It's happened multiple times in our history, not often, but it's happened multiple times. Now, after each one of those 30% drops, the market has rebounded and done extremely well. So being able to weather those storms and tame your animal spirits is important. But that risk is going to be different than if you have a portfolio of cash, stocks, and bonds in, say, a 30-30-30 breakdown, where you're not going to get as much in a drop on a very difficult year, but you're also not going to earn as much either. So you need to be willing to build your portfolio in a way where you understand that there will be drops, but you are willing to accept the potential gain, because the gain always outweighs the drop. But people gauge their portfolio not by how much money they made, because they usually expect to make money, but they gauge their portfolio and their success on how much it lost in a short window of time. My most successful clients, they don't worry about the short term. They make money over the long term. Number 9 is be a tax efficient investor. This is absolutely correct. And we're going to talk about a couple things. There's 3 places that you can invest your money. There's pre-tax accounts, there's Roth accounts, and then there's taxable accounts. Pre-tax accounts is usually an IRA or a 401k where you got a tax deduction when the money went in, but you're going to have to pay taxes later. A Roth account is where you put money in. You did not get a tax deduction up front, but as long as you keep the rules, which are usually pretty simple, you don't have to pay taxes on the money coming out. Or a taxable account where you already have taxes paid, it goes to your bank account, and then you invest. The money that's invested is called your basis. That will not be taxable again, but any earnings or dividends or interest on that money that's invested will have some intra-year taxation, but usually minimal. You can maximize your taxes not only on a current year, but on a lifetime basis. That's where the real winners win with taxes, is reducing lifetime taxes paid. And sometimes that means paying taxes now, but you can really win with tax efficient investing by trying to evaluate the lifetime taxes paid as opposed to trying to just avoid taxes now. But there's some things that you can do where you can do some tax loss harvesting. You can put the proper types of mutual funds in IRAs or tax deferred accounts. You can maximize your interest bearing accounts in IRAs or Roth IRAs because there's no intra-year taxation. That's called asset location as opposed to asset allocation. So being a tax efficient investor is a great way to really build your investment returns. And then number 10, set it, don't forget it. This is correct. We want to be able to build a portfolio that's built to last. You don't have to rebuild your portfolio every year. But a lot of times when I'm building portfolios, we will have a goal in mind. We will build out the portfolio. Say there's 6 holdings. Holdings 1 through 6 will each have their own percentage. Say one's 50%, one's 5%, one's 22%, one's 12%. And we build out that allocation. And as time goes on, each one of those investments will perform differently. And what we'll do is we'll rebalance or harvest gains in positions that have done well and buy positions that have maybe lagged, because a lot of performance in investing is cyclical. Some things do well one year, but they do poor the next, but some things do really well the next year and do poor after that. So rebalancing and staying on course can actually potentially add 1 to 2% of quality return onto your portfolio by rebalancing your assets the proper way. So those are the 10 things. Let's review them really quickly before we go into income distribution strategies. Number 1, start now. Number 2, the economy and the markets are not the same. Number 3, timing is everything. 4, aim for balance. 5, know what you own. 6, tame your animal spirits. Number 7 is better safe than sorry. 8 is manage your risk. 9 is be a tax efficient investor. And number 10 is set it, don't forget it. Thank you, Investopedia, but we're done with you now. That is all fun and games to catch people's eye like mine and buy the damn magazine. But in all practicality, A lot of that doesn't matter. And it's in the wrong order. So now we're going to talk about how investing really matters, what it really looks like. And the first thing we're going to go over is what type of retirement investor you're going to be. The good news for me is when we're trying to answer what type of investor you are, there's already people that have thought through this for me. None of the ideas that advisors have are really original, but occasionally there's some people that build it out the right way. Now, if you're watching on YouTube, you'll see on the screen right now an excerpt from the Retirement Planning Guidebook by Wade Pfau and his crew. If you're not watching this on YouTube, I'll try to describe this as best as I can, and I'll put the link below if you want to go check out the book. It's a phenomenal book if you're trying to plan for retirement and build for retirement. They've come up with a matrix on how to develop the right income strategy for you. Depending on the income strategy, you will build out your portfolio differently. So there's one discussion like we just had about all these great rules about investing, but the next discussion is which of those rules are very practical. So let me give you this an example. So let's say you're 65, you have a couple $1,000,000, you want to retire. Every person that would come through the door has a different idea about how they're going to do this in retirement. In the investment world, they're going to talk about the top right-hand corner here of the probability-based and optionality retirement, where you're basically going to invest your assets in a total return approach that's going to carry more equities than fixed income, and you're going to let the market go up and down throughout your retirement, and that's going to help guide your income distribution strategy, where you may or may not spend a little bit more, but it might help you protect against longevity risk or outliving your money because you have more money working in equities. Another option is if you move left, this is the safety first segment, where there's a hybrid, where you take your $2 million and you put it in an annuity, and the very specific annuity is an income annuity where you make a deal with the insurance company. You give, say, $1 million, and these are just arbitrary numbers, and they promise to pay you a monthly income for the remainder of your life or the remainder of you and your spouse's life. From there, the remaining assets are invested in some capacity with some sort of investment strategy. So you're getting your baseline income needs met with your Social Security most likely and the annuity income. But then you're adding the investment strategy on there where you're able to stack on more income as the market performs. This is a phenomenal hybrid approach that is used often and sometimes leads to actually better outcomes in retirement as far as spending. There's the bottom left that moves to the safety first and commitment, where essentially they want guarantees through their retirement. They're very low risk. These clients have had unusual experiences that lead them to not wanting any market exposure or very little market exposure, where they can lock in their income and they can live the life that they want. This could be a great option, and it just depends on the person. Then there's a hybrid version that's probability-based and commitment-based, where you are still investing a lot in the market, but you are incorporating some ways to protect your risk, and specifically longevity risk, where you have the ability to find that hybrid of big investments and a little bit of guaranteed income. But there's not really much of irreversibility. You kind of lock yourself into that strategy as well. This is a very good matrix to understand how to decide how to invest. So for example, if you're really safety first and you're commitment based, you're going low risk, you're going most likely bonds and annuities or guaranteed annuities. If you're probability based and you want options and flexibility in retirement, you're going to go all investments. You're going to use some sort of ETFs, mutual funds, stocks, or other investment types to be able to build out your investment portfolio for your retirement. More or less, this comes down to the income distribution strategy If you're utilizing a certain strategy from here, let's say you're going all equity or all investment based in your retirement income distribution strategy, you're going to have the ability to withdraw a different amount from your investments for income than you will if you're going to go more of a safety based or safety first strategy. Because that's all what we're looking for. That's the answer to the big question is, I have X amount. How much can I withdraw from this portfolio on an annual basis to be able to live the best life that I can for as long as I can? That's the big kicker. Each strategy is a little bit different, but I promise you I'd go over my investment strategy for clients and what I normally do based on your goals. The things that pop into my head that Investopedia didn't think about is longevity risk, the risk of outliving your money. With inflation, I found this on the web. Sorry, Siri was talking to me. With inflation, not only in consumer goods, but in medical, the costs throughout retirement are going to increase substantially. So we need assets that are going to continue to grow throughout retirement to combat that inflationary risk. You also need assets to continue to grow because if you continue to live longer than you think, which it seems like a lot of people are, you're going to need assets on the back end to protect you. So you're going to need things that continue to grow. If you have very low expenses, I have clients right now that have $39,000 a year of income and they spend $36,000 a year. And it's going to stay like that probably for the foreseeable future. You could use more of a safety first methodology where you're not investing as much and your withdrawal rate is going to be a little bit different. So I'm viewing the risks first. What do we need to protect against? Then we start building out the allocation. How much in equities, how much in fixed income, and how much do you need in income on an annual basis to live the life that you want? As we start to fine tune it a little bit further, I look at, do you have IRAs? Do you have Roth IRAs? Do you have taxable accounts? Because required minimum distributions are going to come into play where we're going to have to distribute money. Do you have accounts that are only tax deferred, which happens often? And what are going to be the tax ramifications? So taxes are the next element. How do we minimize the tax bill throughout your retirement? Then we go to domestic, international, stocks, bonds, ETFs, mutual funds, and how do we build a portfolio that's going to be there to last and provide the potential rate of return needed to keep these goals alive? And then from there, we tame our animal spirits. I will never trade a client's account based on short-term market fluctuation. That is a surefire way to miss great days in the market and ruin a client's portfolio. We will think long-term. We may segment assets out to protect in the short term to make sure you have enough income to survive, a somewhat of a bucketing approach. But these tools become more specific as we dig into a client situation about their experiences, how they've gotten to where they are now, and what they're going to do in retirement that's important to them. In closing, remember, investments are just the fuel. You need to build the plan first. The investments support the plan, and that plan is built to achieve your goals. Goals, plan, assets. People do that in reverse where they mess with the assets and then they start to figure out, what can I do with what I have? If you look at it first, what's most important to you, develop the plan, the tax strategies, the income distribution strategies, what rates of return are needed, what does inflation look like, what do future distributions from retirement accounts look like, how do you want to pass money to heirs? When you start building in the plan, then you can start to invest the assets the right way. Because I think a lot of times what people do is they feel behind and they feel like they need to take chances with their investments that are unnecessary because they feel like they need to catch up. When in all actuality, you're chasing a 20% return, but maybe all you need is 7. You don't need to do things that aren't necessary to the success of your retirement. I hope this was helpful. Please make sure to like and subscribe and make sure to comment what your thoughts are about an investment strategy. I've been hearing some great comments and meeting with prospects that have had some really interesting stories about their investment experiences. I can't wait to see you next week. Thanks for listening. Thanks for watching. See you next time.